78% of our assets are in the fixed income. So when interest rates go down, as they did, it affects a big part of our proportion. Only 15% of our investments are in the equity space, and as you've noticed, the equity space did really well. And real estate, which is a very small proportion, again, you'll notice that there has been some impact, especially on the sales side of our real estate portfolio. So, how does our performance look like? Our performance is, there's little doubt that the last financial year was a difficult one from all perspectives, from an operational perspective, from the environment. However, the fund has demonstrated resilience as we continue to do so, because we've withstood some of the shocks that the pandemic has thrown against us and affected the businesses not only within Uganda, but within the East African region. And this is also a global phenomenon. So from the performance, you'll notice that our assets under management grew by about 17%, which is slightly higher than the growth rate of the economy. Of course, slightly higher, I'm saying that because the growth rate was only 3.3%. So 17% was a lot higher than the growth in the economy. So that's the resilience of the fund, the fact that we are still able to grow at 17%. And I will break this one down to show you why we were able to grow with the assets under management. Last year, we had a balance of assets under management of about 13.3 trillion shillings, and this year that went up to 15 trillion shillings. So this is truly a 15 trillion fund. It is truly a $4.4 billion fund. Our benefits increased by almost 30% on last year. What does this demonstrate to you? In fact, if you net out the benefit with the collection, the growth is about 700 billion shillings. If you look at our financial statements, that appears to be the same amount of the previous year. So what is it telling us? It is telling us that our fund is no longer growing because of collections. It's now beginning to grow largely because of our investment income. It is definitely clear to us that the fund has become mature. We are no longer recruiting as many people to come on board, and the people who have been saving with us are now beginning to take away their money. That's what this graph is telling us. And you'll notice that between 2019-20 and 2020-21, the jump was a lot bigger than in previous years, which again shows us that the growth is attributable to the increase in claimants, but also one more thing. Last year, we allowed people who had COVID to claim under the invalidity benefit, and we've already told you that that number was about almost 2 billion shillings that we paid out, and that is a new benefit which we had not experienced before. How are we performing against all these milestones? Number one, so far on the growth of the fund, you saw the number, we've reached 15.5 trillion shillings. Okay, so we've got a couple of 4.5 trillion shillings to go to our milestone by 2025. The law provides that we will no longer only collect mandatory contributions of 15% from employers who employ 5 individuals and above. The law is dropping that to 1. So if you have your person at home, if you have a formal contract with them, you will have to make a mandatory contribution for them of 15%. Guys, be aware. Second, most importantly, is individuals who currently contribute 15% from the employer and their own salary will be able to top up, I think that's the word, top up on top of their 15%. What is it called? A voluntary contribution. The law was not allowing it. Now you'll be allowed. In other words, if you feel that the 15% you're saving is not sufficient for your retirement, you will be able to top up on that 15% from your either the salary or from your other means and build that number. The third one, and I think for me the most important, is the informal sector. We will be allowed to go to the informal sector and offer them products. Most of the products we believe we can offer to the informal sector are not retirement products, because our research has shown that many people don't really think about their retirement that much, unfortunately. But what they think about are things like unemployment. What will they do when they become unemployed? Second thing they think about is medical. A lot of people have a medical scheme from their company, but there are a lot of people who have their own little business and cannot afford medical insurance. So why can't they save with NSSF and get a medical plan? If you look at our members who qualify for the 45-year, 10-year new amendment that's coming there, the number is about 5.5 trillion shillings, their balances. So if you take 20% of that, it is about 1 trillion shillings. But if you do a further analysis of that, almost 30%, 40%, almost 50% of that number are people who ordinarily would have qualified to get their money. People who are already 55, people who are already 50, and people who are already 60. So they haven't taken their money now because maybe, and I know, I'd like to emphasize it, they are putting their money there because there are very few places where you find a double-digit payment on your investment in this town, right? I'm sure you all invest and know what sort of returns you get and the risks you take. So if you put your money with NSSF, you'll get at least 8%, we said so today, and you'll be doing it at no risk. Whereas if you put it in a kiosk or in tools, farming, as many of us tend to do, you know how difficult it is to look after and how risky it is. So the good news is that the core people who will qualify for that are probably, and I'm stretching this, probably in the region of half a trillion shillings, so 500 billion shillings, who would, I think, come and take up that offer. And as I said, if it is that, with the staggering, with the preparation that we've done, we should be able to keep the funds safe, and therefore investors who want to invest here shouldn't be afraid. The reason we initially were opposed, and it is very public, we were opposed to the 3 clauses that were in there. You recall what those clauses were. The first one was 45 and or 10 years, right? That number was staggering, right? I've got a lot of colleagues who are not here today, 37 years, who have saved for 10 years. They started saving at 27. They have already saved for 10 years. You can even take it as far as 25. Somebody who came in at 15, we are allowed to register people at 15, 16. So 16, 26, you've already saved for 10 years, you can come and take 20%, and so on and so forth. So that was drastic. The second clause in there was people who are out of employment for 3 years and have attained the age of 45. Again, that is zillions of people, because it doesn't matter how much they've saved, but there are a lot of people who fall in that category of they have reached the age of 45, they are no longer in employment, and they are therefore entitled to 40% of their money.